Now it gives me great pleasure to introduce our economic panel. And as I do, if I could ask our distinguished panelists, Avery, Byron, Wien, and Avery Shenfeld to please join me on the stage. So this is once again a special treat, and we are grateful, deeply grateful that you took time out of your busy schedules to join us. Let me just give you a little bit of background on who we'll be hearing from. So Byron Wien, to my immediate right, Byron is the vice chairman of Blackstone Advisory Partners and an expert in analyzing economic and social trends. Prior to joining Blackstone, he served as the chief investment strategist for Picoy Capital and the chief investment strategist for Morgan Stanley. Among his many accomplishments, Byron co-authored Soros on Soros, Staying Ahead of the Curve, was ranked first by Smart Money for his market forecasting in 2000, and named one of the most influential people on Wall Street by the New York Society of Security Analysts. Byron is also an active philanthropist, sitting on the boards of a number of prominent organizations. Avery Shenfeld. Avery is the managing director and chief economist, CIBC World Markets. He has been with CIBC since 1993 and widely recognized as one of Canada's leading economists, consistently ranked as one of the top Canadian economists by institutional investors. Avery is a four-time winner of the Dow Jones Market Watch Forecasting Award and has received awards for forecasting accuracy on the US and Canadian economies by Bloomberg Markets. Prior to CIBC, Avery was a management consultant and on the economic faculties of the University of Toronto and Harvard's John F. Kennedy School of Government. Thank you, gentlemen, for joining us. And I guess Byron and subsequently Avery, perhaps you could lead us off by first sharing with us how you see the world today.
Well, Avery's going first. Yeah.
Oh, he's, if we could have a lavalier. So Byron, maybe you'll take the lead.
Well, but I need a clicker.
Here you go.
Who's got the clicker? Okay. But they didn't mic you up?
No.
But you wanted to go first.
No, you're going first.
Oh, I'm going first. Okay. So I thought I could sort of coast here, and you know, because I've always been envious of Canada. Canada has a very attractive population to natural resource ratio, and so I thought I would hear about a country that didn't have quite the same problems we do. Okay, let me just take you quickly around the world in 10 minutes, and then Avery will take over, and then we'll have some opportunity for questions. Let me say that I had a favorable view of 2014. I thought that this would be a year when, toward the end of the year, the U.S. would be growing close to 3%. We grew faster than that in the third quarter. I think we'll grow at about that rate in the fourth quarter. I think we'll grow at that rate until sometime late 2016, maybe even 2017. I think we're in a prolonged period of slow growth. I think of all the developed countries in the world, the United States is likely to grow faster, certainly than Europe, which is in danger, in my opinion, of slipping back into recession, certainly faster than Japan. It won't grow as fast as some developing markets like China, but don't believe the Chinese numbers. They're not growing as fast as they think they are. So for some of you who are concerned that the United States is going to have a recession sooner than that, I encourage you to look at this chart or table. What this table shows you, you all have it up there, great. It shows you a series of economic parameters. And the middle column shows what they look like when a recession is pending. And the right-hand column shows where we are now. And there are almost none of them that indicate that we're on the brink of a recession. So my view is the next recession in the United States is going to occur sometime late the year after next or even the year after that. So we're in pretty good shape. We're in a prolonged period of slow growth. That doesn't mean we don't have problems. One of the main problems is that earnings are increasing at about 9%. and revenues are only increasing at about 4%. We're using financial engineering to reach the earnings target. Share buybacks are playing a big part of it. But we have all kinds of other problems too, and I thought I'd just touch on them. But first, before I do that, for those of you who think we're in a bubble, I don't think we're in a bubble. This shows trailing 12-month earnings. And bubbles occur at 25 and 30 times earnings, and we're at 17 or 18 times earnings. I think the market can sell at 20 times earnings at these interest rates. So my view is we're a long way from a bubble, and I think the market, I was optimistic about the market this year, and I think the market can have another good year next year. But I don't expect any multiple expansion. I think it'll be driven by earnings. I think earnings can be up 4 or 5% nominally, and there'll be maybe some multiple expansion, but I don't think this is going to, next year, I think the double-digit years are going to be over for a while. Going back, now there are a couple of characteristics of this expansion. A lot of people are using very big numbers, even for this year and next year. And this chart shows you that there's a lot of negative guidance out there. So I've had a 115 estimate for the S&P 500. There are 120 estimates out there, and I'm suspicious of them because of the degree of negative guidance. What does bother me a little bit is this chart. This shows that profit margins have come down, but they're still pretty much at an all-time high. And unit labor costs have hardly increased at all. And this is a problem, that in this cycle, there are a number of characteristics that are different that have long-term implications. Profits are at an all-time high, but unit labor costs haven't increased at all. So that means that corporations have benefited at the expense of labor. And that's caused by two factors. One is globalization, and the second is technology. And neither of those factors are going away. And some of you have heard a lot about the inequality problem. Globalization and technology are the major contributors to that. So I'm concerned about that because I think it has long-term implications and it has political implications too. Maybe I'll just go ahead a little bit. This chart, I think, is one worth focusing on. This is real median family income. And what you see here is that real median family income is lower today than it was in 2007. And that means that doesn't apply to any of you or to me. People who live in houses they own or have significant stock market holdings. But what it does apply to is the person who's drawing a paycheck every 2 weeks in a factory, a retail store, or a fast food establishment, and living from paycheck to paycheck. My net worth is higher than it's ever been. Yours probably is too. But for the average person in the U.S., that's not the case, and that's going to have long-term implications. Now, I just want to talk a little bit about the world in the remaining time. I wonder how many of you are sensitive to how different the European Central Bank monetary policy has been compared to the Federal Reserve. Both had relatively small balance sheets in 2007 before the subprime real estate crisis hit. Then literally overnight, because the banking system around the world was going to melt down, the Federal Reserve went from $1 trillion. It took them 95 years to get them to $1 trillion. Overnight, they went to 2.5, and the European Central Bank shot up accordingly. Then the European Central Bank, when Italy and Spain got into trouble, built its balance sheet up. But they loaned the money to the banks to buy sovereign wealth of the weaker countries, and then the European Central Bank shrunk its balance sheet while the Fed was buying $85 billion a month. So that's why the euro was strong against the dollar. But now the dollar is strong against the euro, and the reason for that is that I think Europe is going to become more expansive in monetary policy, while the Fed is going to be more restrictive. Now, let's just go ahead quickly to Europe. I just want to say a couple of things about it. Europe came out of the recession when we did because of a wrong-headed addiction to austerity. They went back into recession. Now they're out of it, and Germany is slowing, and Germany is the engine of growth for Europe. And if Germany continues to slow, I think Europe is in trouble. But right now, I think they're going to grow 0 to 1%. And on emerging markets, I'm thinking that they have lagged behind seriously. I think you have to be very selective in the emerging markets, but I do believe that they are worth focusing on. The three that I like right now are India, South Korea, and Mexico. Now, here's a chart on India. And now everybody, China's reporting 7.5%. I look at every figure that comes out of China. There's no way they're growing 7.5%. And even if they were, whatever rate they're growing, they have to expand credit 15 to 20% a year. And how much longer can they do that? Here is the real story on China. In 1999, the consumer was 45% of Chinese GDP. Investment spending on state-owned enterprises and infrastructure was 35. They vowed in the 5-year plan they introduced that year to reverse those percentages, and by 2010 they did it. And investment spending was 45 and the consumer was 35. Then in 2010, they said they're going to reverse them again. And so far, they've made no progress. Why? Because they'd slow the economy down, create fewer jobs, and Xi and Li are afraid to take that risk, or so it appears. They give lip service to it, but I think they're afraid to take that risk. So watch the balance of the economy. China must rebalance if it's going to be a sustainable, viable economic democracy. Okay, now I've been asked to talk about my life's lessons. Oh, Japan. I'm very bullish on Japan.
Byron, I'd love to hear Avery's feedback and his review, and then we'll follow
then I'll
up.
do the life's lesson.
Precisely.
You're going to reverse what I was instructed to do?
Yes.
Okay, well, I'd be glad to turn it over to Avery.
Sorry about that.
Okay, let me just say, I got 22 seconds here. So let me just say on Japan, I know there are probably a lot of you who aren't buying it, but they have a number of companies that are showing very dramatic earnings improvement, and it's the cheapest of the three major industrial markets. It's cheaper than the U.S. or Europe. Okay, I'm going to give you my remaining 33 seconds.
I'll take the clicker,
Okay.
too. Thanks very much. So actually, that was a very good setup for me, which is why I wanted Byron to speak first, because I'm going to talk about Canada. And I like using song titles, so for the baby boomers in the room, you may remember the one, Stuck in the Middle with You. I promise not to sing it to you. But that's where sort of Canada finds itself, because the global economy is kind of stuck in the middle between really bad and really good. The U.S. is doing well. That's our major trading partner. But we've seen some slowing in China. Europe is struggling to get out of recession or gain any traction. And global growth matters for a country like Canada. Not because we export so much necessarily to those countries, but the prices for raw materials in many cases do depend on global growth. So where do we see ourselves in that kind of environment? Well, resource prices as a result of this are kind of stuck in the middle between good and bad. Actually, if you measure them in Canadian dollar terms, even though we've seen this slide in oil prices, relative to the average since 2003, we're sort of in the middle. So we certainly had weaker natural gas prices than we've had now. We've seen some recovery in some of the other commodities, but then we've got oil coming off of the highs that we saw earlier this year. Our view on oil is that, we all get very excited when oil drops by 20% or 25%. I would ask you to think back, how many of you remember the 20% drop we had in oil in 2012? If that doesn't ring a bell, what about the 20% drop we had in 2011, or the one we had in 2010? Oil prices are very sensitive to small increases in supply or a bit of shortfall in demand. It takes a big move in price to clear the market. And my view is that as a longer-term investor, I'm looking at where oil is likely to be over the next 5 years. And I think that whatever the outcome, it's going to have to be high enough where Canadian oil sands production continues to grow. If we look at where in the world there is oil in the market, my clicker is, I'm not aiming at the right spot. No? Do you know where I'm supposed to point this? Ah, sorry. There. If you look at where there's oil in the world, I'm going back and forth, you can see that actually some of the recent supply growth has come from unlikely places. Libyan production, for example, surged. ISIS is still somehow selling its oil out of Iraq. So some of that could easily fall by the wayside. Even Russian oil, which is an important, again, supplier to the global economy, is in jeopardy if we look out over the next few years, because I don't know too many people who are going to put their money into the Russian oil sector given all the political instability there. And when you look at where the IEA sees room to grow production between now and the end of the decade, you see Brazil and Canada, a solid third and fourth place on this chart. Well, Brazilian oil, a lot of that is deep water. Canada is oil sands. You're going to need WTI prices in the $80 to $100 a barrel range to make those investments economic. So oil may be depressed today, but actually I think it could easily rebound if global growth does reasonably well, and if we see a blip in production from some of the places at risk, like Libya, Nigeria, Iraq, and so on. I must not be aiming at the right, the left hand. Aha. So what's the situation here in Canada then? Did I skip a slide? The domestic economy has been doing fairly well. We have some concerns here, though, and these are shared by the Bank of Canada, that we can't continue to tap the same sources of growth that we've had since the end of the recession. Remember that Canada did quite well coming out of the gate relative to other countries, particularly even relative to the US in 2010. But a lot of that was built on a healthy banking system and a healthy household sector, so you had willing borrowers, willing lenders meet at very low interest rates to generate growth in consumer spending and housing. We're now seeing Canadians become a little more cautious on consumer credit. It is actually no longer rising as a share of household income. So that's positive from a risk perspective, but it means you're not getting leveraging by the household sector to buy more stuff at the stores. And on the homeowner side, yes, we're still getting rising mortgage balances relative to incomes, but those are simply buying roughly the same number of new houses, just simply at higher prices. Home building is not actually right now an important source of growth. It's running at a high level, but it's not growing from year to year. So the issue for Canada partly here is we need something to replace the response of the household sector to low interest rates as a driver of growth. Now, I'm going to stand up here. Maybe that'll help. I'll stand where Byron was standing. Aha. Some people are worried that Canada, in fact, is facing something much more dire, which is a credit shock. When I go to New York and I speak to a hedge fund, they always ask me, Avery, when is Canada going to experience the same sort of mortgage crisis we had here in the US or that they had over in Europe? And I usually ask them, well, is that the same mortgage crisis you asked me about in 2010 or 2011 or 2012? Because I've been getting the same question for several years. And the reason people are concerned is they look at that chart that shows average debt as a share of average income is higher now in Canada than it was in the US when they entered their financial crisis. And the problem with that chart is that averages can lie. Wayne Gretzky and his brother had the highest average point total over their NHL careers. You've never heard of Wayne's brother, neither have I, and you probably wouldn't give him a $100 million loan, but you'd give Wayne the $100 million loan. So again, what you need to know is what's the income of the people you're lending the money to? And in Canada, that doesn't look anything like it did in the US or in parts of Europe. Actually, if you look at average credit scores in Canada, they've been rising despite rising debt. The reason being is we have distributed more of the debt to the people who have more of the income over the last 4 or 5 years. If you look at the share of Canadian households that are spending more than 40% of their income on debt service, that has not been rising. If you look at defaults, they have not been rising. So by distributing the debt in the right places, I think we've avoided the mistakes we've seen elsewhere. But it is still true that we're starting to, again, tap out the sources of growth we can get by simply lending people more money. So that leaves us, I'm going to skip that. That leaves us dependent on exports to get going. And there it's really a tale of two cities. Calgary, doing just fine. Oil exports have been steadily ramping up. Our view is that between here and the end of the next decade, we will continue to grow that segment of our export basket. That's a quarter of everything Canada sells to the rest of the world is energy products. I said a tale of two cities. One is that city, Calgary. The other city is actually, well, you could say every other city in Canada, because the rest of our export basket has not been doing as well, at least as well as it normally would in an economic recovery, and particularly so until very recently. If you divide up manufactured exports into those that historically were sensitive to the exchange rate and those which were less sensitive, you can see that the recovery in the sensitive industries has not been that strong until very recently. And the reason for that was simply this. Yes, the U.S. is buying more cars, but we're not exporting as many cars and auto parts as we used to at any given level of car sales in the U.S. because too many of those plants closed in Canada when the Canadian dollar was at parity and Canada looked like an expensive place to do business. What we're now starting to see, I think, in the trade numbers is the first response to a somewhat weaker exchange rate. But there's a second leg of the story we need. We not only need to grow the exports from the plants that remain, but we need the currency to stay weak enough in order to attract those new investments, new plants, new expansions to replace what disappeared. My view is that the Canadian dollar still, as a result, still has a bit more downside to go. Yes, you're right if you're thinking, well, wait, if oil prices recover, doesn't that help a recovery in the Canadian dollar? Historically, if oil prices were to bounce back 20%, we would see the Canadian dollar appreciate by a few percent. But the sensitivities on interest differentials go the other way. Part of the reason the Canadian dollar was so strong after 2010 is the Bank of Canada hiked rates while the Fed was still at zero. If the Fed now takes the lead in raising rates and the difference between Canadian and U.S. short-term rates disappears, that actually will knock the Canadian dollar down further. So is the Bank of Canada actually going to cooperate in that sort of outlook? Well, I think it will. I think the Bank of Canada is going to be very gentle in raising rates. And in fact, even at the end of 2016, we expect short-term rates in Canada to be only about 50 basis points higher than they are now. And part of that is that we are more sensitive now to increases in interest rates because of all the debt that's in the household sector. It's going to do more slowing for each rate hike. But the other part of it is that the exchange rate is still providing a bit of a headwind to growth, coupled with the sluggish growth that we're seeing in some of our overseas trading partners. We estimate that in these current global conditions, if the exchange rate stayed roughly where it has been, around 110 Canadian dollar per US dollar, even at full employment, the neutral rate of interest would only be 2%. And if the currency is to weaken, as I think it will, closer to 120 Canadian dollars per US dollar, even then, several years from now, we're only looking at a short-term interest rate of 2.5%. So the Bank of Canada is going to be more patient than the Fed in order to take the Canadian dollar weaker. This is still going to be a world where if you've invested in the bond market, it's not going to be as friendly as it has been because central banks are gradually tightening. As far as the equity market, Byron already pointed this out. It's true for Canada as well. Profit margins are very high by historic standards, justifying a lot of what we've seen in the equity market. And I would argue that, as in the U.S., when I look at valuations on the TSX, they don't look particularly stressed. What we look at actually is a comparison of the earnings yield on stocks, how many dollars of earnings you get per dollar that you invest, relative to the yield you get on a 10-year bond. That spread right now is about 4.5 percentage points in favor of equities over bonds, which is much wider than what you normally see. So actually, stocks are very cheap relative to bonds today. And even if 10-year rates move up to 3%, which I think they will, so we're at 2 now, we think they're going to 3 at some point next year, that spread will still be in favor of stocks. And as far as earnings growth, we actually still think that we're headed for a year of double-digit earnings growth in Canada, even if Byron's right that we don't get it in the US. And really, a large part of that is the magic of a cheaper Canadian dollar. Many of the Canadian companies on the TSX get their revenue in US dollar and have some of their costs in Canadian dollars, which does wonder for margins. So overall, what does a stuck-in-the-middle environment mean? We do think economic growth will pick up a bit in Canada next year. The Fed will hike more than the Bank of Canada. Bond yields will move up. Equities should do reasonably well if global growth improves. What's the risk to this forecast? Well, the risks are that when I look around the rest of the world, not here in North America, I still see a version of what I'd call the 10 plagues. So I'm not going to enumerate all of them for you, but you've got, Ebola in Africa, ISIS running around the Middle East, Iran, don't forget, still working potentially on a nuclear bomb, Russia on the border with Ukraine. So there's a lot of jitters and geopolitical risks out there which could bite us. I think the fortunate thing here in North America is that if I listed all 10, you'd see that none of those are hitting close to home, and that's an advantage we have here. Thanks very much.
Thank you. Byron, could I ask you to comment on a rebuttal?
A rebuttal? Well, I mean, what would I rebut? I mean, he's optimistic about Canada. I have the same worries that he does about geopolitical risk. I would cite, right now we're kind of in a semi-sweet spot. We supposedly have a ceasefire in Ukraine, but it doesn't look like we have one. We do have a ceasefire in Israel-Gaza, but it doesn't look like we have one. The Ukraine situation could have a severe impact on Germany. We have the negotiations, the November 24th deadline on the Iran nuclear talks are going to be met, and we're not going to probably have an agreement by then. We have disagreements in the South China Sea. That's one that probably is taking a favorable turn. But any of these things can go wrong, and they will have an impact on the rest of the world and the price of oil. And I think they're worth worrying about. But as far as the economies of the world are concerned, I'm more worried about Europe than I am about the United States or Canada. I am worried about China slowing. But I do think that aside from some geopolitical risk, I think the outlook for 2015 is reasonably favorable. And you do too, right?
Yeah, I do. I think that, in Europe, I think what's really needed is a bit of a policy turn. I was a bit encouraged, at least, that Italy and France were starting to stand up a bit to Germany and say, well, maybe we won't bring in a big round of budget cuts. You've been telling us to do that so many years in a row. That's not working. But there seems to have been a bit of pushback from the European Commission, and the budget they seem to be settling on actually still involves a little bit of a drag from fiscal policy. So we're putting all our eggs in Europe on this monetary experiment by the ECB working. They are, to some extent, following what the UK did in terms of the funding for lending to try to get essentially bank lending unfrozen. That might do some good. The weaker euro may help euro a bit as Europe on the export side. So we still think they'll be growing next year, but it's of the major regions of the world, it's the one I worry the most about right now.
So would you agree with my statement that we're in a period of relatively slow growth for a prolonged period?
I think that we have to get used to, as we get older, we like sayings like 50 is the new 40. That's what we say when we turn 50. When 60 comes, we'll rephrase that. I would argue that to some extent, when you're looking longer term, sort of 2 is the new 3. And what I mean by that is in Canada, when we look out over the next decade, our growth is probably going to settle to something like 2%, because that's all our population growth, the working age population, will support. And in the US, similarly, even if we allow productivity to pick up from what it has been, you could say that 2.5 is the new 3.5. So we probably have room in the US for a couple of years of growth, more like 3%. But at that point, we'll hit full employment. And even if the Federal Reserve does its job perfectly and we avoid recession, we're looking at growth in the US of 2.5 and 2% in Canada. And Europe, Europe 1 is a pretty good year, actually. And Japan, anything above 0 is getting to be a pretty good year.
I'm interested in your view of oil. Your view is that the price of oil is going to go up because the cost of lifting it is, or finding it is going to go up. Is that the right relationship? I mean, it seems to me that the market determines, and there's a lot of oil around, and some of it can be lifted very cheaply. So even if you choked off some of the high-cost production, the price of oil could stay down where it is right now for a prolonged period of time.
See, I agree. Costs only matter when you're looking at the marginal producer. So the question is, whose oil do you need in the game? Does the U.S., for example, have room, first of all, to meet all the world's oil growth needs, the U.S. or Saudi Arabia, for example, or do we need some of these other players that are higher costs in the game? Even at relatively slow economic growth, the Chinese are buying more cars, as are the Indians and so on, so there's some growth in world oil demand. And when we look at the costs of shale oil in the U.S., the first fields that we tapped were the cheapest. That's why we tapped them first. The next ones we're tapping 3-4 years from now might not be quite as cheap. But I think more importantly, the world is going to need some oil from the likes of Canada, Brazil, and so on, and those are higher cost producers. In the near term, does oil have to suddenly come surging up? I think we're going to need two things to happen for oil to recover in the next year. We're going to need at least a little bit of more global growth. I'm hopeful we'll get that. We'll also need some bump in supply. So it was partly a burst of supply from Libya, for example, that took oil down recently. In 2012, what did the trick was the Saudis, after a while, did cut production after initially denying that they would. So I think if the Saudis are not necessarily at the upcoming OPEC meeting in November, but early next year are not seeing some positive movement in price, they may actually pull back a bit as well. And it doesn't take much of a production curtailment to drive prices up.
Okay, hand me the clicker back. I just want to show one table. Can you put my slides back on? Is that possible, or are they gone forever? What's the answer to that? Is the answer that you can put them back or can't? Okay. Look at this slide. The developing world is consuming less. The developed world is consuming less. The developing world is consuming more. And look at the table to the right. The United States is the most energy irresponsible country in the world. We use 21 barrels of oil per person per year in the U.S. No other country comes close. Western Europe, South Korea, and Japan, 13 to 15. But look at the bottom. Look at China. Look at India. China less than 3, India less than 2. And I travel to those countries, and there is nobody, I mean nobody, and there are 2.5 billion people there who doesn't want a motorized vehicle. So they're not going to stay at 3 and 2 for long. So that's where the demand is going to come from. I don't know whether the roads can handle it. The traffic is pretty murderous as it is. But the demand from those countries, and they, it's interesting to think about economics in terms of the middle class. The United States has a shrinking middle class because of the factors I mentioned before. But China and India have a growing middle class, and that means more energy consumption. And that probably means higher prices over time. And let me just show you one other chart related to Michael's comments. Because, he quoted Seth Klarman, who is one of my heroes. And, you know, the United States operated all year in a state of euphoria. And I write a monthly essay, and in almost every essay I said, you know, we can't have this level of optimism without something bad happening. And in September and October, something bad happened, and it converted the optimism to pessimism just for a short time, but at least it did it for a while. So that correction that we had in September, October was an inevitability, and it was a result of the human factors that relate to the stock market. The stock market isn't all fundamentals, as much as we would all like to think so, because we can analyze the fundamentals. But the psychological factors play a big role.
Yeah, I think it's interesting that there's a tendency to think, though, that if everyone is optimistic, everyone's wrong. And I would take a different quote. I like the one about, if the world's on fire, you know, you better leave the exit even though everyone else is doing the same thing. So there's sometimes when the optimism that we see is justified by the data. I don't think you always want to think that the contrarian is right.
The consensus isn't always wrong.
Exactly.
But it is wrong a fair amount of time. No, I think the consensus is now drifting back toward optimism again, because everybody's going to say, oh, well, that was an inevitable correction. Now we've had it. Now we can go back up again.
Do you want to throw it in?
Sure. I mean, you've both commented on rates. And given the European and Japanese commitment to keep rates to keep them low, very low, how do you view the U.S. being able to raise long-term rates, and how do you see that playing out?
Well, everybody thinks the U.S. is going to raise long-term rates. But I'll say two things about that. One, do you think the economy is strong enough for that to happen? I'm not sure it does, and I'm not sure the Fed thinks so. And not only that, but in a typical cycle in the United States, during the boom time, the unemployment rate is 5%. In a recession, it goes to 10. And 4 years after the bottom of the recession, it's back to 5. We're now 5.25 years, almost 5.5 years, past the bottom of the recession, and it's 5.8. So we have structural problems in employment, and raising rates isn't going to help that. So my view is the Fed is going to act later, and it's going to act more slowly than the consensus view is June of 2015. And I think it'll probably be later, and when they do it, they won't do it a quarter of a point every month. They'll do it much more slowly than that.
I guess
but even if I'm wrong, and they do it then, and they do it, the market doesn't swoon on the first rate increase. It usually, as the great Edson Gould, a strategist during the 50s and 60s, said, it takes 3 steps for the market to stumble.
Yeah, I think the Fed could do a modest dose of rate hikes, but I think that the surprise will be that they might do a modest dose of rate hikes next year and then stop for a year. So in other words, they'll want to get off of 0, which is an extreme stimulus point. There are risks of having 0 rates in terms of people's risk appetite and so on. But I do think that there could be a pause in 2016. You know, the analogy I would draw is here in Canada, we raised rates in 2010. What happened after that? We've been on hold for 4 years. So we could have a dose of rate hikes to get off of 0, but not necessarily a big run in rates. I think the bond market will react much more than the equity market. The only reason the Fed would raise rates next year is because the economy is doing well enough to withstand it, which is good news for earnings. The bond market has not really priced in much. And my theory of the way the bond market reacts is they see someone eat one potato chip, they assume they're going to eat the whole bag, which sometimes is what happens, but sometimes the Fed can surprise you at the other end of it and leave some of the chips in the bag. So I think we will get some dose of rate hikes. In terms of long rates, yes, it's true that 10-year rates in Germany are under 1%. They're very low in Japan as well. We went through the whole
France,
and France too.
And Italy and Spain.
But we went through a lot of the last cycle, if you remember, with Japanese yields at 1%, 1.25%, when U.S. rates were 5%. So the fact that you can get a very low rate in euros doesn't always tempt you to sell that and buy treasuries in dollars. Because if the euro gets weak enough, people may start to think it has upside from where it is, and you are betting on a different currency at that point. So I do think we can have long rates move up, but this is an era of low rates. I think that relative to past cycles, peak rates for the Fed funds rate, peak rates for 10-year bond rates are going to be a lot lower.
I think I'm probably safe in saying there are no Fed governors here. But if there were, I would lecture them en masse and say, look, guys, you know, I've read the principles of the Fed mandate. You guys are responsible for inflation and employment, and there's no inflation. I've studied inflation back to Babylonian times. It is a function of wages and house prices, and wages are going up very slightly. House prices where real people live, not in Toronto, New York, or Los Angeles, or some places like that. But house prices aren't going up much, so there's no inflation. The unemployment rate is higher than the Fed's objective. Now, the Fed unemployment may get down to 5.5%, which is considered to be a trigger point. But the Fed doesn't have any reason to raise rates except for the fact that a lot of people are expecting them to. And so that's why I think they're going to go later and more slowly.
The one interesting thing here in Canada is the unemployment rate in the latest numbers, if you believe them, dropped to 6.5%. Typically in Canada, we think of, our estimates is that 6.2% would be full employment, so we're actually quite close. Inflation is running at 2%, core inflation is at 2.1%. So from the Bank of Canada, if you actually looked at those numbers, you'd be convinced that they're going to be raising rates soon. Their problem is that they don't want to be raising rates before Janet Yellen is raising rates because they don't want to send the currency stronger. They think we need a shift in growth towards exports, and a stronger currency would lean against that. So they're kind of keeping their fingers crossed that the Fed actually does nudge rates up before they have to be pushed into doing so in Canada because they don't want the currency to strengthen here.
Great, thank you. So just two final questions. Avery, this is for you. For most of the family offices and private investors in the room, I mean, given everything that you have shared with us today, what would you say would be the one or two main takeaways that private investors should be mindful of?
Well, I think that it's a world where there's still better return in equities than bonds, I think is one summary point I'd make. But it's not a world where, if you're a poker player, there's that phrase all in. I wouldn't necessarily be all in to equities because of the Moses slide I showed you. There are these plagues on the global economy. Those do blow back into Canada a bit. And then the second takeaway is many Canadians are actually underinvested in the rest of the world. Like, we tend to think of our core portfolio as our Canadian holdings, and then the rest of our portfolio as our international diversification. If you actually think about your lifetime spending plans, you're going to do a lot of spending in US dollars. And I would think about the fact that when you retire, if that's when you're dipping into your money, how many months a year are going to be spending abroad, spending in US dollars? How much of your consumption basket are things that we actually import into Canada where we're effectively buying them in US dollars? And I think right now there's still a bit of a reason there to make sure that you've got enough holdings on the US side of the Canada-US border because the exchange rate at least may work in favor.
Thank you. And Byron, besides for your legendary predictions, I guess over the last couple of years you've been, or the last little bit, you've been sharing some of your life lessons that are a little bit more broader than our portfolios. And if I could ask you to please share some of those to wrap up our session, that would be great.
Okay, but let me just answer Avery's question also, from my point of view. Can you pull up my, let's see, where is this? So this is my radical asset allocation. And this is a very much equity-oriented portfolio. Even the bond portion of it is equity-oriented. So it has 10% in global multinationals, 10% in other US stocks, 10% in Europe, 10% in emerging markets, 5% in Japan, so 45% long only. Then it has 30% in alternatives, 10% in hedge funds, 10% in private equity, 10% in real estate, 5% in gold, 5% in natural resources directly and agricultural commodities, and finally 15% in very high-yielding securities. These are mortgages, leveraged loans, mezzanine financing, high-yielding emerging market debt. I bet none of your portfolios look anything like this. And so I don't expect you to run out during the break and convert to this portfolio. But think about it. There's some ideas here that are worth following. Okay, now let's go to life's lessons. About a year ago, I guess it's a year and a half ago, I was asked to speak at a conference on all the things that Avery and I have been talking about. And a half hour before I was supposed to go on, the conference organizer, who was a friend of mine, came up to me and said, you know, everybody's talking about the market and the economy, interest rates, oil, gold, and so forth, and that's what you're going to talk about, but you're the only one with any flexibility, so we want you to talk about something else. And it was a half hour before I was going to go on. I said, what do you want me to talk about? And he said, well, I've heard you talk about some things you learned during your 50-year career on Wall Street. Why don't you talk about that? I said, I haven't prepared anything. They said, oh, this is on the tip of your tongue, you'll have no trouble. So I did it, and I jotted down 12 things, and I presented those, and then at the end of the conference, somebody said, you know, I got more out of Byron Wien's life lessons than all that other stuff on the economy, but he talked so goddamn fast I couldn't get them all down, so would he please write them up? And I made the terrible mistake of writing up 14 of them. Then somebody put them on the CNBC website. Now, my contract with Blackstone says that I can't write anything that they don't publish first. So I didn't even think about that because I didn't know it went up on the website. And the public affairs guy at Blackstone comes in and says, you're going to be fired. And I said, why? And he said, because you published this thing. I said I had no control over it and explained the circumstances. So then I wrote 20, which we published at Blackstone. So see if some of these resonate with you. The first one is, when you get a new assignment, don't do it the way your predecessor did it. Do it the way you think you should do it. Put your own mark on it from day one, because that's what you'll be remembered for. You will not be remembered for improving on your predecessor. You will be remembered for reinterpreting the job and doing it your own way. Second, network intensely. There's nobody in the room that doesn't think they network intensely. But the key phrase in this one is nurture your network. You've got to continuously send emails to the people in your network. Send them books, organize discussion groups. You've got to keep your network alive. And that's the only way it's going to be useful to you. Third, when you meet somebody new, treat that person as a friend. I spent the first 40 years of my life waiting for somebody to prove that I could trust them. That was an incredible waste of time. You know, treat that person like he was or she was your college roommate. You'll get burned a few times, and I have been 3 times seriously. But your sphere of influence will increase enormously if you take a new employee or a new acquaintance and embrace them warmly. And I do that now, and it's enormously increased my effectiveness. Read all the time. You've always got to be learning in this business. You cannot coast. I've given talks at Harvard Business School and a number of universities, and I also gave one at Baupost, Seth Klarman's firm. But I also gave one at the University of Texas. And when I got to read all the time, a kid raised his hand and said, well, when do you find the time to do all that reading? And I said, well, I'll be honest with you. I never watch a baseball, basketball, football, or hockey game on television. The audience booed me. So if you ever get down to Texas, don't say anything like that. Get enough sleep. All these lists always have diet and exercise. But people don't realize sleep is the fuel of performance. Probably some of you have commuting problems. You've got to get enough sleep. If you do, you'll be amazed at the difference that it makes. I was coming up here, caught an early plane. I made sure I got enough sleep so I didn't fall asleep on the podium here. Evolve. Don't try to do the same thing through your entire career. I've had a number of different phases. I started in corporate life, became a security analyst, then a portfolio manager, sector strategist, U.S. strategist, global strategist, first on the sell side, then on the buy side. And every time I regenerated myself. So when you go into a new phase, it delivers the exhilaration of regeneration. Travel extensively. And when you go to a third world country, always try to meet the locals in that country. Exploit your contacts mercilessly. You'd be surprised how much more you'll get out of the travel experience if you get out of the churches, get out of the museums, and interact with the people. I try to do that everywhere I go. When you're interviewing somebody or meeting somebody for the first time, try to find out what happened to that person before he or she was 17 that will give you an insight into how risk-prone or risk-averse they're likely to be. I claim there's something that happens to everyone as a kid that determines how the nature of risk that person is willing to take later in life. On philanthropy, my approach is try to relieve pain rather than spread joy. So I give a very limited amount of money to art museums, music, and the theater, but I give a lot of money to education, healthcare, and social service. I've missed a lot of good parties by doing this because the art museums give great parties. But I think I'm making the world a better place. And more importantly, I'm trying to create a situation where disadvantaged people have the same opportunities I had. Younger people tend to be insecure. They tend to talk a lot about how terrific they are. Most people are in their 40s before they've done enough good things that other people are talking about them, their accomplishments for them. Try to get there as soon as possible. You'll become a much more likable person if others are talking about your achievements. Take the time to give those who work for you the tutelage, guidance, and training they need. Most of us go from one project to another, leaving our support staff behind. You've got to take the time to give them the reinforcement. I get plenty of reinforcement from making presentations like this. So I don't need anybody at Blackstone or at Morgan Stanley to tell me I'm doing a good job, which is a good thing, because nobody at Blackstone or Morgan Stanley ever does it. But because I get my reinforcement from you. But the people who work for me, they don't get it if they don't get it from me. So I've got to be sure to give it to them, and you've got to be sure to give it to the people who support you. Let's see. At the beginning of every year, try to think of how you can do your job better than you've ever done it before. Write it down and give yourself a self-evaluation at the end of the year. Every employee at Blackstone does this, and I think it really pays off for us. The hard way is always the right way. Never take shortcuts. If you get a reputation in your career as a shortcutter, it can be a career killer. And all you have to do is ask the people who worked at Drexel about that. Now, there are 20 of these. You're probably not going to remember all of them. If you remember only one, remember 15. Don't try to be better than your competitors. There's always going to be somebody smarter than you. Try to be different. All the success I've had in my career, I've had because I did something different from my competitors. Like life lessons, like the 10 surprises, like the smartest man in Europe, and half a dozen other things. You don't have to do one a year. But if you're creative in your approach to a job, you have a better chance of succeeding, because there will certainly be smarter people, but there may not be more creative people. So harness your creativity. It is the path to success. When you're interviewing somebody for a job, or when you're changing jobs or interviewing somebody, don't be afraid to give them the advice or take the advice yourself. Don't be afraid to take the job that pays less. I've had 5 jobs. I took 2 for money. They were both mistakes. I took pay cuts to take the 3 of them, including the Morgan Stanley and Blackstone jobs. Why did I do that? I did it because those firms were offering me a job I thought I would love. And I thought if I loved it, I would do it well. And I thought if I loved it and did it well and the firm was fair, I'd be compensated accordingly. And I'll tell you, I have made more money in my career than I ever thought possible. And it's only because I was smart enough to take the jobs that paid less. I give this advice to kids, and they blow me off. But they always, for 10 grand, they'll take a job they're going to hate. I can't figure it out. But if you take a job that you're going to love in a firm that is fair, you'll be compensated accordingly. And there's a perfect job out there for everyone, and most people never find it. But if you do find it, and I've been lucky enough to have a few of them, everything in your life, your marriage, your athletic prowess, everything gets better. So keep looking if you don't have it, because there is the right job out there for you, and don't just stay in a job you're miserable in because you're secure.
Byron, if we could ask you for one more, that would be wonderful.
Well, I've only got a couple more. So I'll go through them quickly. When your children are grown, or if you have no children, find a younger person to mentor. You'll be surprised at how much you learn. Every year, try doing something outside your comfort zone. It could be athletic, like running a marathon. It could be going to a conference populated by people very different from those you ordinarily associate with, or it could be traveling to a third world country alone. And all these things add to the process of self-discovery, and the more you know about yourself, the more effective you'll be as a person. Finally, never retire. If you work forever, I believe you can live forever. I know there's a lot of biological evidence against this one, but I'm going with the theory anyway.
Thank you so very much.